Hi and welcome to everybody to this new episode of Bitcoin Not Crypto and Web3 Ki Dunya with me, with Kashif, and we have a fantastic honorable guest called Mr. Clive Thompson with us. We've changed the format. We've always been talking about macro and Bitcoin and how the world is going through a dramatic transformative change in the 2020s. But to learn from his deep insights and perspective, we have a retired wealth manager from one of the largest financial institutions in the world, based out of Switzerland. His name is Mr. Clive Thompson. Clive, welcome to the show.
Well, thank you very much for inviting me. I'm pleased to speak to your guests in India and all around the world.
And before we start today, and it's going to be an entertainment filled, popcorn grabbing, seat belt tight kind of a package because it's going to be filled with a lot of serious questions. But if you're the Netflix kind of a guy, this episode is not for you. But if you're really somebody who's interested in his future, about your kids, about his education, about your money not losing its purchasing power, about gold, about Bitcoin, about hard assets, then this episode is definitely a must watch for you. And you should stick glued to your seats without any further ado. So let's start with the episode. Clive, I want to ask you first a little bit about yourself and your background so that the audience gets to know you, they can relate to you, and then we'll take it forward.
So my career, my entire career was in wealth management, working for private banks, mostly in Switzerland. I've been investing money now for 50 years. I've now retired, so I'm not running any businesses. I have no website. I don't take any money for anything. So all I can do is tell you what I think about investments, banks, and the way the world is going to go. I have no axe to grind, no agenda, because I tell you what I think, and what I tell you is what is the way I invest my own money, without being influenced by what the banks are telling you, which might not always be 100% right.
Such a nice intro, such a lovely personified message that you have no agenda. Everybody has an agenda today, but it's good to always meet with people who actually do not have an agenda and they can speak their mind and their heart out. So let's start the discussion. Clive, I want to understand, for the basic understanding of our audience, if you would like to define the word inflation, what inflation really means, and what monetary system do we live in, and how do fiat currencies are really meant to be inflationary in nature? Because if they are not, then the whole system collapses. If you could elaborate a little bit on that, I think people will get a perspective as to what is going on today in global macro, and how do you see the way forward?
When people hear the word inflation in the modern world, they think of it as rising prices. But if we go back in history to 100 years ago, even 80 years ago, the word inflation, as defined in the dictionary and as understood by the population at large, was an inflation of the money supply. I repeat that, inflation of the money supply. And the symptom of inflating the money supply was one of rising prices. So that was the historical meaning. Now, how did the word inflation change its meaning from an inflation of the money supply to the modern meaning of a change in prices? And that was mainly down to John Maynard Keynes, the famous UK economist, who alleged that, or claimed that there was little relationship between the amount of money in circulation and the general level of prices. And he had some good point. He expanded the fact that prices can go up and down in wars, and due to shortages, and due to the weather and all kinds of other things. And he said it wasn't just printing more money. But from the Austrian School of Economics, more money means that there's more money to go around and people are going to buy more. Now, if we step forward to the modern world, we haven't seen prices rise as much over the last decades as we have seen the inflation of the money supply. Money supply is up massively. I haven't got the figure in my head, but it's hundreds of percent. And the inflation of the money supply is somewhat lower than that. It's about half from memory. I think the figures are about since 1959. I think it's about. I'm talking about the USA here. About 90% inflation of the money supply and about 40% inflation of the prices. Now, The reason prices haven't gone up as much as the money supply is thanks to the modern world and technology. If you buy a frozen pizza, for example, it's probably been made by robots, and robots can work 24 hours a day, and that's taking away from the manufacturing of just about everything one of the components of cost, which is human labor. So the amount of human labor which goes into anything you buy, whether it be an iPhone or a car or a TV or a table or just food, the amount of human labor which went into that is somewhat reduced. And therefore, the amount of the manufacturing has been done to a large extent by robotization. And robots are very peaceful creatures. They don't demand pay rises, and they don't really care whether there's more money or less money in the system. They don't need to go and buy themselves luxury yachts or anything like that. Whereas the man in the street, if he's working and he sees that the price of things are rising, he's going to want more and more and more, and so he's going to demand pay rises. So that's that the robotization, the automation, is one of the reasons why prices haven't risen for the mass-produced goods as much as they have as the money supply. But if you take the non-mass-produced goods, and by that I would include gold, I would include equities, their businesses in a way. I include works of art like such as the Van Gogh or Leonardo da Vinci painting.
Even real estate.
And real estate, all of these have risen much faster because out there are people who are accumulating this excess money supply, and then they leverage it up with borrowing, and they can bid up the prices of these assets to even higher levels. So the question is, what are we going to get in the future? Are we going to get a lot of inflation, and what's it going to do to prices? So we'll come to that, but I'll let you fire some more questions.
So I think the summary of your talk is that it's the same as Milton Friedman has actually famously said, which is that inflation is everywhere and every time a monetary phenomenon. It's basically to do with the money supply, with the M2. The more money that is being printed, either in the form of creation of debt at the government level or at the private debt through the banking channel, increases the money supply, which increases either the prices of goods and services, which are core to the basket of CPI, or in our case, in the last 10 years, has been the more desired products like financial products like stocks, or to a very good extent, real estate. Look at what real estate prices in 2012 in the US was. It was, I think, at the lowest, although it was a cyclical downturn from 2008. It actually troughed in 2012, but it has gone up by a factor of 5x from there, which means that eventually all this money that is being pouring into the system in the terms of quantitative easing from the Federal Reserve, which they may not categorically want to say that this is increase in money supply, but actually it is, and it is creating that wealth effect, which is also leading to more income disproportionality and inequality, because the rich are able to borrow, as you just said, and leverage it, buy more scarce assets because the money itself is not scarce, and thereby bidding up the prices of all these products, even if necessarily it's not the case for you know uh, food or groceries or different kinds of consumable products, because they are being produced more efficiently with the help of technology. Is that a
Well, I've
right,
got
correct summary of what you said?
absolutely. I mean, actually, I've got a very good example of that. My father, who died a few years ago, when I was going through his estate papers, I came across his first house purchase back in the early 1950s. He paid £1,000 for it in the early 50s and sold it a few years later for a few maybe £2,000. But you'll realise £1,000 is like about 1,500 US dollars or $1,300. It's not a lot of money. And there was a letter from his insurance company. In those days, they used to handwrite the letters or do them on typewriters. So the insurance agent had written to him said, congratulating him on having successfully made such a large profit on selling his house. But of course, even going from 1950 to 1956 or 57 when he sold it, that profit was due to the monetary inflation, the increase in the money supply back then. Now, out of curiosity, I thought I'll go and have a look up this house, see if it's still there. You can use an application in the UK called Zoopla, which I did, and I found that its theoretical value, according to the application Zoopla, was now in excess of £500,000.
Oh,
So that shows you that it's 5,000 times what he paid. Is it 5,000 or
that's right.
500? 500 times what he paid. Sorry, 500 times what he paid.
Kashif, you got to come in here.
Yeah. So,
You
I
know,
think,
I bought my first home in the late 70s. I was in my early 20s. I paid £12,500 for it then. It was a one-bedroom flat. And it's in Buckhurst Hill, which is part of Greater London. It's on the subway system of London. And I went back there a year or two ago, and there was a for sale sign out of it. And I looked it up, and they were asking £250,000, 20 times what I'd paid for it.
yeah, absolutely. So, Clive, my question is, when we are seeing this exponential rise in prices of real estate, exponential rise in the prices of, uh, you know, uh, luxury goods, and there are two kinds of so if I see, when the government says that the inflation is 2% or 4% or 5%, uh, they have included items as per their own convenience. The ground reality is very different from what the government says. So if the government says, and by the way, including every government on this planet, it's not only about US or about UK. Whenever they say that the inflation rate is this much, they are only including the goods where they feel, okay, include this and exclude this. But the ground reality is very different. Now, my question is, Clive, uh, you have seen 70s, 80s, 60s, and there was this, the people used to invest in fixed income securities, gold. There was this idea of generating enough to counter inflation, but now the inflation is growing at an exponential pace. What different strategies now people need to adopt in future, that are very different from what you did maybe in your whole career?
Good question. So first of all, I'll just comment on the consumer price index, and then I'll comment on
Yeah,
strategies. The consumer price index is an index of things which are consumed by the public at large. But it is a rigged index all around the world, because it's based on what people consume. So if, for example, a housewife consumes or was buying potatoes for $1 and bread for $1, the index should be 2. Now, if the price of potatoes doubles from 1 to 2, we've now got potatoes worth 2 and bread worth 1, so the index should go from 2 to 3. But the housewife says, I can't afford the potatoes anymore, so instead of buying £1 of potatoes and £1 of bread, I'll buy £2 of bread. So the index stays at 2 because there's no more expenditure on the potatoes, or less expenditure on the potatoes, and therefore the retail price index doesn't seem to go up. The other fraud, if you like, which goes on in the retail price index or consumer price index around the world is one of improvements. If you buy a TV today for the same price as you bought a TV 5 years ago, that's a price reduction. Why is it a price reduction from the CPI's point of view? It's a price reduction because you get more for your money. The new TV's got an internet connection, and it's got more buttons and whistles and things. So they will call an improvement in the quality of a product a price reduction, even though you have no choice but to buy the latest state-of-the-art item.
yeah,
So we must remember that in a certain sense, if you were buying exactly the same basket of goods that you were buying 10 or 20 years ago, the CPI would have increased by a greater percentage than is actually declared by the government. And that's because people's spending habits have changed, and in a certain sense, they're getting more quality or technology for their money than they used to. So that's on the CPI. Now coming back to strategies for protecting our wealth, I'll say one more thing on the CPI. The CPI is just an index. Everybody has got their own inflation rate. My
yeah,
inflation rate is not the same as yours, and the inflation rate of a poor person, a man in the street, is not the same as the inflation rate for a very wealthy person. So the wealthier you are, the higher the inflation rate is. And
yeah,
the reason for that is wealthy people spend their money on rarer, more expensive items, whether it be yachts or expensive cars or expensive rare paintings or collector's items of various descriptions, which are rising because they're limited supply. Whereas the man in the street is spending his money on things which are, in theory, in unlimited supply. I mean, if Apple wanted to make twice as many iPhones, they could probably do so if there were enough people out there to buy them, and it wouldn't cost any more. It's not like if the number of people wanted to buy iPhones doubled, that the price would double. That wouldn't happen. Whereas if the number of people who want to buy, let's say, a rare gold coin from 150 years ago, it's much in demand. If the number of people wanted to buy that doubled, well, the price of the rare coin is going to go up a lot more. So the inflation for richer people is much higher than the inflation for the man in the street. Now, what should you do to protect your wealth? My first comment is, this is addressed to people who've got something to save. I mean, if you've got nothing to save, there's not really anything to protect. But first and foremost, you need to limit your exposure to the kind of fiat assets which are being inflated. And at the end of the day, there's two types of fiat assets which are out there. One is the money supply, which is generally classified as M1 or M2, which is notes and coins in circulation, bank deposits, money market funds, and that sort of thing. And the other thing which I would include as part of the inflation is the level of government debt. Because when the government issues debt, yes, it takes money out of M2, out of the money system to spend it. And I'll come back to that because it's not always like that and hasn't always been like that. But they take money out of M2 to spend it. But the level of government debt goes up, which is a promise to have more money in the system when that debt matures. Now, what's been going on, especially in the last decade, is most governments around the world have resorted to not borrowing from the public at large as much as they've been borrowing from the central bank. So in the USA, it'd be the Federal Reserve, in the UK, the Bank of England, in Europe, the ECB, and so forth. So the central banks have, in a way, done their duty to solve all these crises we've had. The 2008 banking crisis, money had to be pumped in the system to save the banking system, and then we had COVID, and we probably had a recession as well in between. So to do that, the central banks have been buying the government debt that the government needs, the money the government needs to borrow. So the government needs to borrow money to spend money on which it couldn't raise in taxes. So it doesn't borrow from the public, it borrows from the Federal Reserve or from the Bank of England or the ECB. But where does the ECB or the Federal Reserve or the Bank of England get the money from? Well, they print it out of thin air. So from a balance sheet perspective, the central banks have a liability, which is money they printed, and an asset, which is the treasury bond they bought. So as long as the government borrows from the central bank, that is instantly inflationary because money is coming into the system and expanding the money supply. And when there's more money out there, someone somewhere has got it. And as you can imagine, there's always people at the end of the chain, the wealthy, who are running businesses, who are trying to make a profit, and they do make a profit. And as they build up their bank balances, then they want to spend those bank balances on all kinds of things, including labor. So if there's not enough workers to go around, they have to bid up, offer higher salaries, and that in turn feeds through to the inflation rate because salaries are now higher, and the man in the street suffers from higher prices due to the labor cost going into the manufacture of the goods he consumes. So how to protect yourself?
I would like to point here that I am absolutely in strong critique of the government as well as the central banks, especially because first of all I'm a Bitcoiner. I understand it from the Bitcoin perspective that increase in the money supply is causing all these market distortions. Also, the fact that the more important thing for me is that these guys are not honest. They don't want to come around on the on with honesty and tell you exactly what's happening on. In fact, if you were just seen about a couple of weeks back, there was a 3 sigma event in the US Treasury auctions. Now that is a 1 in a 50 million probabilities. I mean, this is like it should not have happened. I don't know if you've been if you've just noticed, but a lot of these distortions are happening, and people, I must warn you here that what Clive is also saying, something is going to happen, maybe tomorrow, maybe in a year, maybe in 5 years, but something really bad is coming down the way. And we know this because of the very, very high debt to GDP ratios of these advanced economies. If you look at the unfunded liabilities of the US, including Medicare, Medicaid, and pensions and all the other government liabilities, along with private household debt, it comes to almost like $100 trillion in the US itself, which is like 4.5 times of the GDP. And this is a conservative number. People like Stanley Druckenmiller is one of the biggest hedge fund managers in the world, is saying it's like $200 trillion. Now, can you imagine a country running on 6 times debt to GDP ratio in terms of unfunded liabilities and funded liabilities? And also, even if we were to exclude these unfunded liabilities, the US government debt itself today is $130 trillion, is 130% of the GDP, which is close to like 32, $33 trillion. The interest on those uh, uh, debt instruments is also increased tremendously because of the increase in interest rates. So, what we are now seeing in 2023 today is basically a culmination of many, many things coming together. And this is what is going to lead to the great reset, for which Clive also has a very good thesis, and we'll delve into it. But before he delves into it, let me just tell you what are all these aspects. The first is a record student loan crisis, which is brewed up in the US. It's the student loan debt is at a highest level it's ever been, even inflation adjusted. This credit card debt is close to $1 trillion. Then you have the commercial real estate, which is again going down under. In fact, just recently there was another bank called PacWest, which is like the third largest bank in California. It has gone down. It has now been purchased at lower than its market value by some other bank. And it seems that people have become indifferent to it, as if they don't even care that banks are failing. They feel that everything is going to be all right. It's that extreme confidence in the Federal Reserve, which people have generated in their minds, that the Fed is just going to print magically some more money and everything again is all going to be all right. That pseudo sense of confidence is what is going to lead people down in terms of their expectations getting crushed because of the Great Reset. And also, if you look at it, the the commercial real estate, the banking crisis, the student loan crisis, and what all these are all culminating at the same time, perhaps maybe in the fall this year, or maybe in 2024, or who knows when. Eventually, central banking and all these things are games of confidence. Once the confidence gets shattered, then you see not only a debt crisis but a currency crisis, and God knows what's going to lead us from there to the other side. But I want to take your opinion, because Clive, I've listened to you on one of the podcasts, and you had some very interesting takes as to what's actually going to happen and how it's going to happen. Perhaps if you could share some light on that, and also maybe a tentative timeline in your mind, depending upon the current macro conditions.
Sure. So when you said something bad is going to happen, you are absolutely right, and it can play out in quite a few years, quite a few ways. One, of course, could be a situation of very high inflation, hyperinflation. Another one could be a collapse in the bond market, which means super high interest rates and a total destruction of the economy. But one of the ones which I think, no, well, one other is what's called a bail-in. Bail-ins have got a lot of historical precedent. A bail-in is when governments decide they haven't got enough money, so everybody's going to have part of their bank deposit effectively seized or lent to the government against their wishes. I think Brazil did that in the Collor Plan. So it's those are varieties of changes which have happened historically. But the one I think is most likely scenario in the future is what I'm calling a global currency reset. And I do use the word global deliberately, because I think when it happens to the first G10 country, the other G10 countries and the rest of the world will be forced to follow suit very, very rapidly. So what is a reset? A reset is when the government decides that they will launch a new currency on which the economy will run. So the idea would be, for this example, I'm going to use the central bank digital currency, the CBDC, which is coming all around the world. And the CBDC, we all know and believe that when it arrives, it'll be convertible one-to-one with your existing pounds, dollars, euros, Swiss francs, whatever you happen to own. So essentially, it's the same. At the start, it looks like and feels like the same thing, but it's not the same thing. It's as different as the banknotes in your pocket are from the money in your bank. They're not the same. The money in your bank is just a bit of paper created by the bank. The banknotes in your pocket are a liability of your central bank. So the CBDC, when it's created, will be a direct liability of the central bank. Now, that CBDC wallet might be operated on your behalf by your bank, but it will still be a different type of asset from the money in the bank. The bank won't be able to take the money in your CBDC wallet and lend it to somebody for a mortgage. It's not the same thing. But it's still convertible one-to-one. You'll be able to ask your bank electronically or whatever way you speak to your bank to move money out of your bank account into your CBDC wallet or back again. And there'll be some limits as to how much you can have in your CBDC wallet initially. Later on, they may extend those limits, and they'll certainly extend what you can do with the CBDC wallet to ultimately include all types of transactions. Initially, it'll probably be just to get your salary and pay for things in the shops. But later on, I can see that evolving, and very, very quickly, actually, evolving into a wallet which you're effectively using for all kinds of transactions, whether it be house purchases or stock market transactions or foreign exchange transactions or whatever. Now, why am I mentioning the CBDC? Because when it exists, the government has in fact created a second currency, albeit to the man in the street, to you and I, it looks exactly the same, because it's like going to the bank with 100 cents and getting $1, or going to the bank and getting $1 and getting 100 cents. They're two different things, but you can change them one for the other freely. Just as you could in America up until 1933, you could take your ounce of gold into the bank and get $33, $23, I think it was, or something like that, $22. Or you could take in $22 and get an ounce of gold, until they made that illegal. So effectively, up until then in the United States, gold and dollars to the man in the street were exactly the same thing. And then one day they said, sorry, you can only have the paper dollars, you can't have the physical gold. And they became two different things. So what I see potentially coming down the line, at some point we're going to get a crisis because of the levels of government debt. They are all around the world extremely high for the countries concerned. Broadly speaking, the highest levels they've ever been in broad terms. There's some exceptions, but they are all, and broadly speaking, at very dangerous levels according to, for example, the Maastricht Treaty. And I think the United States has got a Maastricht Treaty said you should never have a debt to GDP ratio of more than 60, and that's for Europe. And the United States said, I think the figure was 70. Well, they're all well above those levels now. You said it's 130. Well, it is 130 in the United States, and of that,
Italy and Britain are even worse, Clive.
Yeah,
And
a large percentage of that is owned by you, me, your pension fund, and the government of China and other central banks around the world, which is called the public at large. Some of it is owned, but not much, is owned by the central bank, the Federal Reserve. I think it's something like 90-something% is owned by the public at large, and the remaining 30% is owned by the Federal Reserve, which is where the printing has come in recently. So at some point, interest rates start to rise, and they have to rise. I'm going to take the United States as an example because the figures are freely available on their website. You can work it out yourself. They have to rise because the plan, and that's the official budget of the United States, is to increase the debt owned by the public to effectively double it in the next decade. Now that's a far cry from their plan a decade ago. A decade ago, their plan was to gradually reduce the debt to GDP ratio until eventually, way out of the distant future, and I think 2060 or something, they were planning to get the debt to GDP ratio down to zero. Well, that's all gone out the window. Now they've decided, and this is planned in the official budget, which you can see on the Congressional Budget Office's website, to double the amount of debt. That basically means they're going to spend every year, and every year without exception, more money than they can collect in taxes, big time. The trouble with that is when they produce their budget a decade ago, their plan was to get by now to get down to a debt to GDP ratio of 60, and we've just seen we're at 130, so we're at double the debt to GDP ratio, which means they spent way more than the planned budget. When you look at the details on a yearly basis, it wasn't that big a difference. It was like they spent about 2% a year more than expected, and they received taxes of about 1% a year less than expected. But the net effect of that was, due to the leverage effect of receipts and payments, was that they took their debt to GDP ratio to over 100% when they planned to have got it down to 60% by now. So if we take the same level of error from the Congressional Budget Office for the next 10 years, we don't get to a doubling of the debt, we get to a tripling of the debt. And I've done my maths on that. That would be debt. I'm now talking about debt owned by the public at large, which would be moving from to over about 300%. At that level, and at an interest rate of about 9%, the entirety of the tax take that the government thinks they're going to get in 10 years' time will be consumed by interest payments on the national debt. So it's obvious we're not going to get there without something happening. If I paint a corollary, imagine you have you're a worker, you have a credit card, you've been living a bit beyond your means. Every time you want something, you use your credit card, and your balance is getting bigger and bigger. That's the national debt. And as the balance gets bigger, the interest on it gets higher and higher. And at some point, the amount you owe is many, many times your salary. So we're talking many, many multiples of what the American government takes as taxes is what is owed. But much worse, the interest you have to pay to the credit card company exceeds your entire salary. Now, that's where I think we're going to get to in a decade, if it were possible. Now, it is impossible to get there because something will collapse before there'll be a crisis of confidence, and people will run a mile, and the government won't be able to fund itself except at even higher interest rates, which is not going to happen. And that's the point where they say, oh my God, there's a crisis. Everybody's trying to buy everything in the shop. The shop shelves are empty. All of these people have become hoarders. So we're going to stop you from doing that. And the way we're going to stop you from doing that is we're going to limit how much money you can take out of your bank to put in your CBDC wallet. And don't forget, the only type of money which will be accepted in the shops then will be CBDCs. They're not going to be taking cash or dollars, especially when the government says you can only spend CBDCs in the shop. So you'll suddenly find you've got all your dollars left in the bank, and you're only allowed to convert a certain amount, $500, $1,000, $10,000, whatever they decide, into CBDCs for spending the shops, because they don't want you hoarding goods. Because if you can get your hands on spending, if you could spend your money, you would, because you know that the whole system is about to go down the Swanee. So at that point, when they suspend or bottleneck the amount of money, your amount of cash in your bank that you can convert into CBDCs or put into your CBDC wallet, that's when the American currency has effectively split into two. Same thing will be happening around the world. Because the day that happens in America, or I'm going to say Japan, because I'm going to get to Japan in a minute, which I think could be the first to go.
I think so. I agree with you. Yeah, but please go on. I completely agree with you. Something is wrong in the South China Sea bases or Japan. Something is going to break.
Yeah. So when this happens, everybody's going to say, "Oh my God, my currency might be next," and we're all going to run to the shops to get something tangible while we still can. Now, it also means that any other assets you've got which are denominated in fiat, such as bonds or money market funds or deposits, these will be left behind in what is now an obsolete currency, a defunct currency. It's one you can't spend. Now, initially, you may think it's got some value, and people may swap it with you at a discount for CBDCs, because they believe that the suspension will be lifted later on. So you might be able to, on the day they announce the suspension, be able to trade 100 of your old dollars for 70 new dollars or CBDC dollars. And I would say a month or two later, you'll be lucky to get 20 CBDC dollars for that. And a year later, you won't get anything. So there will be a lot of bag holders because the money does exist. If I take American M2, that's 21 trillion of money which is out there. by the way, which is not enough money to fund that increase in national debt that's proposed by the Congressional Budget Office, let alone 3 times that CBO is proposing to double it. That 21 trillion isn't enough, but someone's going to be holding that 21 trillion US dollars and the same amounts or equivalent amounts in the respective countries around the world. So they're going to effectively find they're now holding a defunct currency. And I don't know about you guys, but I've been collecting banknotes from all around the world, and my collection is filled with these defunct notes with lots of zeros on them in some cases, sometimes not too many zeros, but they come from all kinds of third world countries, but not so much from the G10 nations. But once the first G10 nation has a currency reset, well, if it's not your country, you want to run to the bank, get your money out, and buy anything you can lay your hands on as fast as you possibly can, because you're next.
So, how do you feel this entire thing is going to play out? I mean, is it because the debt markets will be not functioning very well, like we've just seen a Three Sigma event in the US Treasury auctions, which leads to a little crisis of confidence, and it's ultimately a confidence game that the bond markets are signaling and telling us that something is wrong. Something is really, really, really wrong. But it's just that people are stupid enough, even after listening to this episode, if they do not take actions and invest in hard assets, I don't know what else they can blame it for. But having said that, I want to ask you, how do you really, what do you see will be the tipping point? It will be like there is a big, miscorrelation in the bond markets, and to save the bond markets, which the governments any which ways do, they will always have to print money and monetize it, and which leads to a currency market uh, distortion and collapse eventually, and this is going to gradually play out over like 3 years, 5 years? Or you think this is going to be like a boom, all of a sudden event? You just wake up on a Monday morning and you see that your bank account is closed, seized. The government makes an announcement on the TV that this is just a temporary measure and everything will be all right. No need to worry. All your money is safe. And eventually, that will be the reason to bring in the CBDC, because the governments will always be one step ahead in thinking, okay, what could be the logical consequence, the next step? And they say, now we've solved all your problems. Here is the new CBDC. This is going to be the new currency. You can always change it from the old to the new, but we will let the rich people die on the hill. We will not allow them to change too much at one time, because obviously it will create more distortion. So we will just cap it at a certain limit. And how do you think it is going to play it? I mean,
So
it happens gradually and then suddenly,
not
and
gradually.
because of some disjointing, or it happens in a slow and figurative manner that people can actually plan for it.
Um, So ideally, the government would like the CBDC to be up and running and used as the main currency for all transactions before it happens. But they may not have a choice in that. The reality is, around the world, we have lots of countries and we have lots of events. And by events, these are events which could cause a panic on their own. They could be natural disasters, they could be wars, they could be pandemics, they could be a banking crisis. You can probably think of lots of things which might go wrong. Some black swan event which happens somewhere in a major economy and causes people to panic. I can't tell you what it'll be, because you can't. Black swan events by their nature, you don't see it coming. Let's say it might be a California earthquake, for example. Who knows? But we have always had these events, and if we have one which is perceived as significant for the country concerned, and if affecting an already fragile economy, a fragile level of government debt, where people say, oh my God, they're never going to be able to solve this one except by inflating the system out of hell, people start running to the bank and getting their money. So when it happens, I think it comes fairly quickly. Ahead of time, ahead of the date they close the banks, because this is one of the features of which will happen. As we have the event, maybe it's a lot of civil unrest, political unrest, maybe there's a coup, who knows. But as we go into the event, there'll be a lot of people running around wondering what to do. And people are like crowds at a cinema. They might be all sitting at a cinema and someone says, I think I can smell smoke. But until someone shouts fire, then they all try to run out of the door at the same time. And the same with investments. When they need to put their money into something tangible, the whole crowd will be trying to do it. And as a banker, I can tell you, when everybody's trying to do the same thing at the same time, it's impossible. And I'm going to give you two examples of that from my personal career. Back in 2008, at my desk, when the banks were all going bust, we had a lot of clients ringing up saying, buy me gold bars and keep them in custody for me. So I'd ring my Forex dealer and say, can you buy some gold bars? And by the way, in Switzerland, buying gold bars is something you do every day. It's normal. It's normal business. You buy and sell them, and people the bank holds them in custody. Nobody ever comes to collect them, but in theory they can. I mean, when I say theory, they can, but usually they don't. But people, when they think the whole system is about to go flat, they buy gold bars. So people were ringing up saying, buy me some gold bars and put them in custody so I can come and collect them when I get to Switzerland one of these days. And I was ringing my Forex dealer saying, can you buy gold bars? And he said, well, sorry, Clive, there's a 3-week waiting list. The demand is so high, the refineries can't deliver the gold bars. And I said, well, what's that mean for my client? And he said, well, your client is at risk. If we don't get the gold bars, we can't give them to the client. You're at risk for the 3 weeks. And of course, clients were very upset that we couldn't instantly give them the gold bars as we always had done in the past. You know, in the past, when the rank said, buy me a gold bar, it would be about $60,000 these days, but a bit maybe less then. They got it instantly. It was in their portfolio and it was theirs. It wasn't on the bank's balance sheet. But now, what they had was a promise by the bank to deliver them a gold bar, which we hadn't got. Of course, they all got their gold bars at the end, but it was a very fraught period for the clients. That was one example. And another example was the 1987 stock market crash. It might be, you're young guys, so you might not remember that. But 1987 was a year when virtually every stock market in the world went down about 30% in one day. And I remember personally ringing up or trying to ring up to buy some shares because the idea would be you buy anything. Now, I was at that time trying to buy in London. Now, one of the mishaps was the UK had had its first and only and last ever hurricane the night before. So the entirety of London was down. All the roads were down, the railways were down, the subway was not working. Nobody could get to work. And these faxes, because there were faxes those days, no email, were piling up on the brokers' desks from all around the world, from Asia, from India, from Africa, even from the Americas, saying sell, because everybody wanted to sell before America opened, because we already knew because of the way it was going. Iran had just declared war on America. Well, America had attacked, bombed an Iranian warship or something like that, an Iranian rig, and Iran had declared war. And why did America attack Iran? Because America wanted to defend Saddam Hussein at the time because he'd got the oil. But anyway, long and short of it was the interest rates were going up, the dollar was collapsing, and everybody knew that Wall Street was going to, or Armageddon was going to happen in Wall Street. So they're trying to sell through London. But London, there was nobody there because not anybody could get to work. Even the stock exchange couldn't open. So I was trying to ring and buy shares. I couldn't buy anything. But there was one or two people trading, but not the people I was in touch with. And the stock market plunged 30%. Not only in London, but when Wall Street opened, the same thing happened. You couldn't buy for love nor money when everybody else was trying to do it. Later in the day, we tried to buy through Wall Street, but of course it was by telephone in those days. You still couldn't do it because you couldn't get through to the brokers.
What a fantastic example you've given. I mean, the audience who's listening to this podcast will get to know that, how two real time examples, real examples of Clive Thompson, that what he's just trying to tell you, that there will be a time, when it happens suddenly, then everybody is trying to run in the same direction. Then it's not possible. So if you want to prepare something, if you know that if you're able to connect the dots, you need to prepare today. You cannot just say that, oh, everything is okay. I mean, I'll just figure out when it will happen. When it will happen, you might not be able to do it. Right. So that is the reason. So the learning out of what just Clive said, that if you believe that there is something wrong with the system, if there is something wrong happening, if there is something wrong with the way money is being printed, if there is something wrong with the number of inflation that are coming up, you need to connect the dot and plan it today. So Clive, my next question is, what is your take on Bitcoin? Where you think that Bitcoin, because since you have spent your life in an old school of thought, You know the ways of doing it through, the formula. Okay, I need to do this, I need to invest here, I need to suggest my client, to invest in securities, gold and whatnot. But then suddenly, in the later stage of your life, you encountered Bitcoin. Now, how do you see it? What is the future? And if
Kashif
I
is
am,
not so
if
old.
I'm,
Huh? He's not so old. I think he
yeah,
understands Bitcoin very well because
yeah,
Bitcoin
yeah,
is.
absolutely,
In fact, he
absolutely,
paradoxically answered the exact that we could not take the gold out for 3 weeks, but Bitcoin is much superior because it's saleable
yeah,
across time and space, and you can just verify and audit it or audit on the blockchain who owns what, which what, and it's exactly the same characteristics as gold. You cannot print more Bitcoin. It's
uh,
backed by mathematics and cryptography. It's very secure. It has 350 to 400 extra hashes of compute power per second. So I think he knows inherently deep inside that it's a superior
yeah,
form
yeah.
of gold. It's just
My
that
question,
we want to listen from you, Clive. We're very
yeah,
because we Bitcoiners, we really want to listen from you.
yeah. So my question to him is that he has spent his 40 years or 45 years in one domain, suggesting something that is like the way he knows that, that way is the perfect way to do it. But now suddenly he's seeing Bitcoin. And what is his take on Bitcoin and how Bitcoin fits into the scheme of things?
Um, an asset is something which is rare and people want to own it. I think Bitcoin has proven itself that people do want to own it, just as they want to hold gold. We could argue that both gold and Bitcoin, neither of them have any income, but the world at large wants to own it. And Bitcoin's had its multiple chances to fade away and become nothing. And on each of these attempts to fade away and become nothing, it's come back with a vengeance. So there is absolutely no doubt in my mind that Bitcoin is here to stay. And I think that Bitcoin and the blockchain technologies, which would encompass wider crypto, are here to stay. We're seeing a lot of trends going on. The first one is the blockchain technologies, which Bitcoin was the first, are being used everywhere. That means crypto and blockchains are not going to go away at all, and Bitcoin is the king daddy of all of that. Yes, it has no utility, but there is a utility, and that is one of a store of value. And people, I think, have largely accepted that. The second thing which is going on, we're seeing large, well-known organizations such as BlackRock and Fidelity and many others applying to have Bitcoin funds or Bitcoin ETFs. And as far as they're concerned, it's an asset. Why is it an asset? Because people want to own it. So if someone wants to own something, it is an asset. And as these large investment managers, and there's countless of them trying to find ways to give their clients access to Bitcoin and a wider range of cryptocurrencies, as they start to make it available, clients will be able to buy it and they'll want to buy it. And of course, mustn't forget large institutions make a fee from peddling these products, so they're not stupid. If they get bringing out an ETF or a fund connected to Bitcoin, they're going to be writing a paper on it, espousing the pros and cons, and hoping that some of their customers see the pros and not the cons and go for it. So there will be down the line more people who want to own Bitcoin, and I think in the long run the price will head upwards, especially as people start to shy away from currencies. Now, I also would like to stress I'm not a maximalist. I'm not saying anyone should have more than a small percentage in Bitcoin. As a wealth manager, perhaps the right level is only 1% today. But I can see that percentage increasing amongst wealth managers over time. And by the way, there are many wealth managers who say the correct percentage is zero. I'm a little bit of an outlier if I'm saying 1%. But I do think that in times of monetary uncertainty, those who are paid to advise their clients will look around for possible solutions, and they will include all kinds of tangible assets. And Bitcoin will certainly fit into that list because it's one more diversification you can have. And the other thing which I think has proven itself and is quite important from those who are proposing it is it's not terribly correlated with other asset classes. The advantage of that is you reduce if you have a small enough position, you slightly reduce the volatility of your portfolio, whilst being in that position, you still have a lot of upside. So if Bitcoin does 10x, so it goes to 1 million, as some people think it will, and I think it goes to infinity eventually. But that's after the currency crisis, and it's infinity in the old currency. But if Bitcoin does 10x, that 1% is now 10% of your portfolio. It's a lovely boost to your portfolio if you get that. But again, I would like to say a lot of things are going to do 10x in the years to come. So I'm not suggesting that it's the only asset you want to own. You want to own a lot of different things.
But Clive,
Like,
BlackRock is suggesting to have 84.9% of your portfolio in Bitcoin in a 2022 published report to its clients. I don't know if you
Um,
read that report, but it's like I can.
I think I read it in my dreams.
No, it's fact. I can share the link with you. It's an open public disclosure, but it's a very small disclosure under some terms which have been. But
Okay.
just to augment and also to critique you a little bit, how I can augment you is because you're absolutely right on Bitcoin in the thought direction that because it's a commodity money which is outside the control of governments. Even China tried to ban it, could not change its hash rate. In fact, the hash rate has come out 4 times, on top of 2021's hash rate. So it's something which exists outside the system. The governments cannot control, and they cannot, ban it. Second, it's commodity money. It's counterparty risk-free money, just like gold. And the third better advantage as compared to gold is that because Bitcoin is, saleable across space, unlike gold. You could send $1 billion today of Bitcoin from here to Switzerland, and it all arrives in 10 minutes and a final confirmation in 60 minutes, and you can audit it on the blockchain. And personally, the critique that I wanted to say was because I think you've not gone very deep into the rabbit hole. I personally believe that everything else apart from Bitcoin is a shitcoin, because actual use case of blockchain is to create the perfect money, which Bitcoin has already been created. And honestly, it is because it's completely decentralized, and you cannot build scalability and security on top of. You can build scalability and security on top of decentralization, but you cannot build decentralization on top of scalability, which most of these other crypto so-called blockchains are trying to achieve. But having said that, guys, if you've actually had some fun in this entire discussion, I would really like that you could just go ahead and subscribe to the channel, because we'll keep coming up with a lot of such knowledgeable guests from across the world. But just to summarize before we leave, I think I want to ask you one or two questions, and then maybe Kashif can take over. Is that you said that there are four possibilities. One is that we have sustained periods of inflation or hyperinflation. The other one is a big confidence shakeup, which leads to everybody running from the banks, and then the government coming up on a Sunday and that is your possibility, the possibility number two. And the third thing is that you could have a complete a debt market collapse, which I do not think the governments can ever allow. If there is ever they have to choose between the bond markets and the currency, they will let the currency go to hell, but they will always choose the bond market because the
Yeah. So
confidence game is.
that's basically when instead of trying to sell the bonds to the public, they sell it to the Federal Reserve, to the central bank. But yes, you're right.
Yeah. So what do you think? I mean, what is the probability you assign towards the three? Either a black swan event, which leads to a collapse in the debt markets, which leads to more printing and further hyperinflation, or it all plays up together. But what is the probability you have for your thesis to play out, that one day suddenly on a Sunday, different governments from across the world come on television and say, "Okay, we're launching CBDC, which is going to be backed by this, or whatever," and then you cannot withdraw your money from the banks from Monday. The banks remain closed, and then maybe 3-4 days down the line, we see everything.
So,
What is the
so
probability?
first of all, the CBDC and the currency reset are not the same thing. The CBDC is just the issue of another form of what looks like the same money, but the reset effectively happens when you suddenly can't add more money from your bank account. You can't take your maturing Apple bond and take the proceeds and put it into your CBDC wallet. That's when they cut the tie. The peg which used to exist at 1-to-1 stops existing. Now you only have the CBDC wallet. So I think, first of all, they'd like this to happen after the CBDC is up and running, because it makes it a lot easier to do. if we have a currency reset before then due to a crisis, it's going to be quite messy, chaotic. There's going to be a lot of civil unrest to go with it, of course. So in a certain sense, the government would prefer to keep kicking the can down the road as far as they can. And when they have no choice, they have a plan B, which will be put a bottleneck across the CBDC so you can't move too much money into it. But let's just look at what becomes beyond, because I think rather than have a bail-in or a collapse, I think the CBDC converting to becoming a second country or new currency or dual currency is going to be the preferred solution. Why is that? Because it will create huge prosperity for the world in the aftermath. Now, as it happens, it's a wealth destruction event because everybody, everywhere, gets their cash assets, their bonds, and including government bonds and bonds from corporations, effectively zeroed because they're now in a defunct, obsolete currency. Now, for the man in the street, if you happen to have a mortgage or a credit card debt, that's a good thing because your mortgage and credit card debt were contracted in the old currency and it stays in the old currency. So you now have a mortgage in a currency which doesn't even exist anymore. So you have no mortgage. So you used to own a house and a mortgage. Now you own just a house. Good news for borrowers. If you happen to be a corporation and you've got a bond out there which has to be repaid in 5 years, well, suddenly your bond is now in a defunct currency which nobody wants and it's worthless. So you can write its value down to zero. You can still repay it out of the old money, but the old money is worthless. If you happen to be a government and you've got a lot of national debt, that debt is denominated in the old currency. Brilliant. You don't have to service it anymore. Well, you can service it, but servicing a currency which is completely worthless is easy to do. What you can now do in the new currency is borrow money because your debt to GDP ratio in the new currency, which we're now assuming will be the CBDC, is zero. So on day one, after they've had the reset, there's going to be a lot of people who are hard done by. These will be old age pensioners who've lost their money, which was now in the bank. It'll be pension funds. It'll be people without jobs. All kinds of people will suddenly be screaming blue murder. But the government will be able to re-leverage and borrow money to give everybody a little bailout. So I think everybody will get a free gift from the government in the new currency to help kickstart the system so nobody's starving on day one. I think that they'll introduce a universal basic income, and I think they'll bail out the pensioners and the pension funds to make sure nobody's starving. All brilliant, but even after they've done all of that, the debt to GDP ratio isn't going to pass 10% compared with the hundreds of percent it is today. So the government can do it. Now, why does it bring in a massive age of prosperity? Well, if you think about it, all these companies which no longer have any debt can now re-borrow to build factories and hire employees. The individuals who had mortgages and credit card debts, suddenly they don't exist. They've got more money in their pocket. They can rehypothecate their homes to borrow again, to start spending again. And of course, the government, which has got no debt anymore, or very little after they've compensated some people, the government can start all kinds of spending programs and infrastructure without having the slightest worrying, knowing they can go all the way up to 100% or more of debt without having any trouble. That's going to push them years and years into the future, way beyond the current administration. So it's somebody else's problem. So all that spending coming into the system is a massive boost for the global economy. It'll be far greater than the Marshall Plan saw, and it'll herald in an era of great prosperity. Of course, once all this prosperity starts to happen, it will have an effect on all kinds of asset prices. I think stocks and shares will do very well because they're going to be making a lot more profit than before. I think gold will do well because people say, I still don't trust the new currency. It's like if you have an earthquake, people say that was the warning, the big one's yet to come. They fear the next earthquake. Well, if we have a currency reset, they'll fear the next one's just around the corner. They'll be frightened of it coming again. And so they'll say, I'm not going to trust the currency the second time around. I lost money last time. This time I'm not trusting it. So I'm going to own gold. So gold will become more attractive, as will Bitcoin.
So, but the crux of the matter remains that the borrowers will be bailed out at the expense of the savers. Is
Yes.
this what I understand?
If you're a saver, you lose your money.
So all the boomers who are going to be retiring, thinking that they're going to have those $1 million in their accounts, are suddenly going to go on the streets. Is this what you're suggesting?
Well, everybody gets bailed out at the subsistence level. The government's going
Uh,
to put money into your wallet so you can still eat, and to some extent that you might find that a small percentage of the money you've got gets converted. I mean, there's been many examples in history where they changed 10,000 of your old money for one of the new money. I mean, if you take, for example, when we had the reunification of Germany, they allowed people to change some of their old marks at 1 to 1. The next bunch of old marks, they gave you 60 cents. And the next bunch of marks, they gave you 6 cents or 6 pfennigs. There'll be some sort of conversation to make sure that people aren't on the street. But yes, if your money happens to be in the wrong place, if it's cash and bonds, you'll be effectively wiped out and you'll start poor. But those people who are very rich are generally people, I'm not talking about the retirees, I'm talking about people who are the Bill Gates of this world. They're the sort of people who will say, I'm going to start again, and they'll make money again.
I cannot thank you enough, Clive, for being today a part of this show and educating our audience about what are all the possibilities. I mean, I've listened to a lot of theses. I'm generally in the sustained periods of inflation and perhaps even hyperinflation camp. But I think out of the probability assignments, I think yours is a decent probability, because eventually everybody gets to save face, and the governments as well. But we Bitcoiners feel that in order to reach to the Bitcoin standard, we feel that a lot of pain is coming, and I think that is something which you will definitely agree with us. And I think this decade is going to be tumultuous. So everybody, on all our listeners here, we would really recommend to you know go and follow Clive. Clive, where can they follow you so that they can understand, they can actually learn more about you and your thesis? If you could give some insights on
Yeah.
that, please.
I don't have any YouTube or Twitter channels, but I sometimes get invited on other people's channels. So look for my name, Clive Thompson. And the other thing, I write regularly in LinkedIn. So anybody who's on LinkedIn can subscribe and follow me, and they'll read my posts on this subject and many similar subjects related to central banks and currencies and gold and Bitcoin. I have written an article on Bitcoin, by the way. I don't know if you knew that. It was a positive one, by the way.
Thank you so much, Clive. And by the way, we will also put it in the Kashif bhai, we can also put it in the description about Clive and his
Yeah,
LinkedIn
yeah.
channel.
Yeah,
I will
sure.
I will certainly
So
do that.
so people get to know it. Uh, Kashif, you have any parting questions? Any last questions before we can just say adieu to the gentleman?
Yeah, yeah.
Um,
Before I say goodbye to you, I mean, if you have to recommend a portfolio, perfect portfolio at this point of time, what will be that? What we should be having in that portfolio?
I'm fully aware that all kinds of assets in a crisis will drop in value, but you have to own them while you can now, or buy them now, rather than expect to be able to buy them in the middle of a crisis. I come back to the point I made earlier: try and buy something when prices are cheap. Everybody's trying to do this. Everyone's running, and it's hard to get anyone to pick up the phone. So build your portfolio now of different things. Perfect portfolio, I think you should be heavily in equities. Why heavily in equities? Because companies are very adept at managing the woes of the world. They're globally diversified. They have tangible assets. They have property. They have machines. They have goodwill. They have customers. For the most part, companies are still going to survive whatever the governments throw at us. I think you need to have gold and physical silver, because if we find the banks are shut and we don't know how long it carries on for, or we don't know what level of civil unrest there'll be, it can come in handy for bailing out your neighbours, helping people around you, your family and friends, so that they can buy their food, because people will very quickly learn what a silver coin is and what a gold coin is. I mean, it'll be very, very fast if we have a banking crisis and they shut the banks for a few weeks. And the last thing, I mean, maybe I say a few weeks, who knows, it might be a lot longer than that. And if you have a mortgage, keep your mortgage, but perhaps match it with equivalent number of, don't pay it off, but buy gold and silver, so that if we have a reset, you still got your gold and silver, but you don't have the mortgage. That would be my idea there. But yeah, if you can find a tangible asset that you like, for example, if you like vintage whiskies from distilleries which don't exist anymore, that could be a good investment. I like collectible coins from years gone by. Try and get something which is got not too much premium, where you can buy it on eBay or somewhere like that. So you're buying it at the price you could sell it for, broadly speaking. But the kind of things which are good to look at have a little bit of premium over the gold and silver price, and will never be worth less than what gold and silver is worth.
So, guys, what Clive is suggesting, Kashif, is that people should go ahead and create a mortgage and buy real assets, hard assets, uh, and try to do it as soon as possible, because it's not a question of if the great reset will happen. According to him, it's a question of when it will happen. But remember, folks, this is none of this is financial advice, and you have to take your decisions depending upon your own financial conditions, whether you're even able to pay up this mortgage what you're planning to take in order to buy those real assets before this this great reset happens, which we do not know. Nobody knows actually when it's going to happen. But one thing for sure, it's a mathematical certainty that some kind of great reset will happen. So let's stay tuned to that
Yeah.
ethos, and let's say adieu to and bye bye to Clive.
Yeah. And
Thank you
maybe
very
one
much,
very
Clive.
last point,
Sure.
very important point for your listeners: don't get rid of all your cash, because you never know when you'll need some cash for emergencies like medical bills or something
Yeah.
unforeseen. So the amount of cash you need to keep depends on the individual, whether he's got a job, whether he's got multiple sources of income. I can't tell you what the amount is, but I think if you can keep 3 to 6 or 9 months cash or a year's cash, that's useful, because you never know what the world will throw at you.
With this
Thank you
thought,
so
I
much for
think.
such valuable insights, Clive.
Thank you very much, Clive. We'll certainly will bring you once again, maybe in future at some point of time. But thank you very much for your inputs. Thank you, Suveett. And listeners, it's a request that if you really like this content, please do hit the like button and do subscribe and do follow Clive Thompson on the LinkedIn. With this thought, thank you very much, guys. Until we catch again.
And thank you for inviting me on your show. Bye bye now.
Thank
Bye.
you.
Bye.
Bye bye.